Hello and welcome back to our notes on job order costing. So we're resuming this video on page 26 of your notes. So I was saying what we actually have to do with manufacturing overhead is we have this balance in manufacturing overhead. At the end of the accounting period, we need to zero out the balance in manufacturing overhead. So what we could do here is we can do one of two things to do that. Again, this would be done at the end of the year as an adjusting journal entry. We can close it out for cost of goods sold, or we could prorate it among finished goods, work in process, and cost of goods sold. So if we look on page 27, what's our journal entry if we close it out for cost of goods sold? Well, what I'm going to do, the way I could do this is if I put $3,000 here, then it's 12 minus 12 is 0. So I'm going to debit cost of goods sold for $3,000, and I will credit manufacturing overhead for $3,000. And by doing that, I zero out the manufacturing overhead key account, and I move it to cost of goods sold. And if you think about it, that actually makes more sense because according to what we had, right, we had $12,000 of actual overhead, but we only applied $9,000, so we actually have to add $3,000 more to cost of goods sold. Now, this would be is if the balance in manufacturing overhead is immaterial. This would be if it's material. Materiality refers to how big the balance of it is and whether it would make an effect or any kind of effect on someone's judgment of the financial statements. If this were $3,000 out of $30 million, it just doesn't make a big difference. So we would close it out to cost of goods sold. But if it's $3,000 out of $10,000, then it does make a big difference, and we would want to prorate it or allocate it among work in process, finished goods, and cost of goods sold. So let's look at the second journal entry here to prorate it or allocate it. So what we could do is we're going to look back at this job cost sheet on page 25, and we're going to look, well, how much overhead was applied to jobs that are still in work in process, how much overhead was applied to jobs in cost of goods sold, and how much overhead was applied to jobs in finished goods. And so we can look back over here and we can see job 101 was our cost of goods sold, job 102 was our finished good, job 103 was our work in process. So if I look at job 103, for example, I can see overhead of $2,000, overhead of $4,000, overhead of $3,000. So I'm going to use those to calculate how much of that $3,000 is going to go to manufacturing overhead, finished goods, and cost of goods sold. Okay? So I'm going to come over here and let's say MOH applied to WIP would be $2,000. I'm going to say MOH applied to jobs in finished goods is equal to our $4,000. And then I'm going to say MOH applied to those jobs to cost of goods sold is equal to our $3,000. So then I'm going to use that, and if you add up all these, you get a total of $9,000, which is the amount of overhead that we applied. So I'm going to use these ratios to go through and calculate out how much of that $3,000 goes to WIP, how much goes to finished goods, how much goes to cost of goods sold. So I'm going to say 2 of the 9,000 times the $3,000 of under-applied overhead will go to WIP, which equals our $667, round up just a little bit. So then I can say 4 nights, 4,000 of the 9,000 times the $3,000 that's underapplied goes to finished goods. So that gives us our 1,000. Okay, then I'm going to say 3 nights times the 3,000, so 1/3 to cost of goods sold, which is our $1,000. So then I can use that to do my journal entry. It's going to be a debit to WIP for $667, a debit to finished goods. Okay, and then a credit, a debit to cost of goods sold. I forgot about that. $1,000, and then the credit to manufacturing overhead for $3,000 right there. Okay, so that would be our journal entry to prorate among finished goods, cost of goods sold, and work in process. Okay, so I have a problem on the next page, on page 28. Why don't you give that a try? And you might want to pause the video to do this problem, and then we'll go ahead and take a look and see how you do. Okay. All right, so welcome back. We have this problem right here. Let's take a look at that. Tiger had actual manufacturing costs of $1,210,000, predetermined overhead rate of $4 per machine hour. Our company also worked 290,000 machine hours during the period. Their manufacturing overhead is overapplied, underapplied, and by how much. So first thing we're going to do is we'll say our actual overhead is actually equal to our $1,210,000. Our applied, the way we apply overhead, right, recall, is to calculate the predetermined overhead rate, which has already been calculated for us, and multiply the predetermined overhead rate times the amount of allocation base used. So 290,000 times the 4, which gives us our $1,160,000. Okay, so we applied $1,160,000. We had actual of $1,210,000. We subtracted is $50,000. Actual is more than applied, so therefore it's $50,000 underapplied. Sorry, underapplied. Okay, $50,000 underapplied because actual is more than applied. You didn't apply enough. Okay, so let's take a look here at our overapplied and underapplied manufacturing overhead summary. If it's underapplied, that means it's a debit to cost of goods sold, credit to manufacturing overhead. Therefore, that will increase cost of goods sold. If it's underapplied, we would debit work in process, debit finished goods, and debit cost of goods sold, and credit manufacturing overhead. The debit, these are both asset accounts, so those will also go up. Of course, cost of goods sold is an expense account, and the debit and expense account, it goes up. If it's overapplied, on the other hand, so if we have that credit balance in manufacturing overhead, we would debit manufacturing overhead, and then we would credit cost of goods sold. A credit to cost of goods sold would decrease cost of goods sold. And of course, then if we will use the allocation approach, which means it's material, what we would do is we would debit manufacturing overhead, credit WIP, credit finished goods, and then credit cost of goods sold. Okay? So we look at this final quick check problem right over here. This quick check problem says, what effect will overapplied overhead have on a company's net operating income? The overapplied overhead is going to decrease cost of goods sold in either situation. Whether it's closed out to cost of goods sold or prorated, it will still decrease cost of goods sold. It's just that here, it will decrease cost of goods sold more than over here because all of it goes here. Only some of it goes here. Okay, so it's going to decrease cost of goods sold. As cost of goods sold goes down, net operating income will go up. Okay, as cost of goods sold goes down, net operating income will go up because the way I calculate net operating income is sales minus cost of goods sold. The right answer there is A. Okay? Let's take a look at page 29 right over here. Why don't you go ahead and do this problem? This is another practice problem. You might want to pause the lecture video and then come back to this. Okay? All right, so let's take a look here. Our predetermined overhead rate, we take estimated overhead divided by estimated allocation basis. So it's 260 divided by 650, which equals 0.4. And so the interpretation of this is we apply 40 cents of overhead for every direct labor dollar. It says here during the first month of the year, Henderson had direct labor costs of $80,000. How much would be applied? So we're applying it on the basis of direct labor. Take our 80,000 times our 0.4, which gives us $32,000. What's the journal entry? And it's debit WIP, credit manufacturing overhead, 32,000. Is the overhead under or over applied if actual overhead is 36,000? I take my 36,000 minus my 32,000. Actual is more than applied. That means under applied by $4,000. And then what's the journal entry to close it out to cost of goods sold? Well, the journal entry would be our debit to cost of goods sold, and then our credit, debit cost of goods sold, credit manufacturing overhead for $4,000. Okay? And again, if that doesn't make sense, you might want to think of it in terms of the T account over here. What you have is that 36 right there. You have 32 here. You have $4,000 left over. So to get rid of this, you put $4,000 here, and then you have to move it to cost of goods sold because that's extra expenses that you have during the accounting period that you have not included in your cost of goods sold so far, because your cost of goods sold during the accounting period was only $32,000, and the reason that's different is because this is based upon an estimated manufacturing overhead rate, and the reason that we use the estimated manufacturing overhead rate rather than the actual rate is for pricing and for budgeting purposes. Okay? Moving on to page 30 right over here, job order costing for service companies. Service companies such as an automobile repair shop, or a hospital, or a law firm, or a consulting company would be using job order costing systems, and they would use something similar to a job cost sheet to accumulate the costs that they would incur, and then they would apply overhead just like what we've seen with the manufacturing. Okay? And then we can talk about our summary of our journal entries right over here. I'm not going to go over every single one of these. You can see these just as well as I can, and we've gone over these quite a bit throughout the chapter, but pages 31 and 32 is a good summary of all the journal entries that we've talked about so far. Okay? So, now that brings us on to page 33. I'm going to go ahead and stop this video and do a final video for this chapter that covers pages 33 and 34, which are additional problems in your notes. Thanks. Bye.